Hello and welcome to today's stream. It has been a while, but today, in this stream, we'll be taking a look at JPMorgan's deal to acquire First Republic Bank. We're just looking at their slideshow presentation on it. Of course, May 1st, so relatively recent. Time does fly when JPMorgan is the largest U.S. bank. Yeah, definitely, largest U.S. bank. So we're looking at that, talk a bit about the banks. Nothing. Basically, everything I'll say is either just basic, like why having unmarked losses is an issue from just the basic accounting 101 perspective, right? Of where you have assets equals liabilities plus equity. The nice thing using Microsoft Edge, so I can annotate. But conceptually, right, as a quick accounting 101, right, this formula has to balance. Both sides have to equal one another. For a bank, your liabilities are customer or client deposit, aka your money at a bank, and the asset side. Assets are like loans, treasuries, etc. Right? And then equity is money shareholders put in retained earnings, like net income. Right? So that kind of is like accounting 101. Like four bullet points. Essentially, right? And so the entire issue with the banks is that interest rates have gone up, and when interest rates go up, bond prices go down because you have cash flow divided by 1 plus interest rate to whatever time frame. And that's how this kind of works, right? The dollar today is worth more than a dollar in 5 years. You can think of it intuitively of in 5 years there's going to be inflation, and so the dollar is maybe only worth 90 cents actually, right? And so it's kind of like, and of course the opposite works, where if interest rates go down, then of course it's not necessarily as binary, but generally speaking, then right, bonds go up. So the entire issue then with the bank is you have this phenomena: interest rates go up, which they have been. If you look at your savings account, I guess it depends on your bank. Some banks haven't really. But if you have certain banks like Wealthfront, you're getting 4.55%, which is pretty good. Just I was in high school, I get 0.05 at a credit union. So you can only imagine what you're going to get JPMorgan or Wells Fargo. But so you have that issue, right? Where your assets, so all of a sudden, your assets are now worth less, right? Your assets are worth less. Your equity is still flat because it's probably gone up a bit because a bank, you probably have positive net income, but for your net income margin, just natural arbitrage that banks do. But your liabilities are also constant, right? Because a dollar in your bank account is relatively speaking, right? But the issue is, right, your asset side has gone down. It's equities are constant. Seems but your so pretty much there's a mismatch between your assets and liabilities. And so the entire issue, right? Because not all of these assets are cash, right? Some of these are loans, some of these are treasuries. And the real issue comes when some of those treasuries are 10-year, 20-year treasuries, right? And those 10-year, 20-year treasuries, they're paying maybe 2 or 3% versus a 1 month treasury that's paying 4% or 3%, whatnot, right? So those 10, 20-year treasuries are worth a whole lot less than they are. And of course, at the end of the 10 or 20 years, you'll get your $100 back. But the issue is, if all of your liabilities decide to pull out the door, all your customers want this bank run, right? Because again, at the end of the day, a good quote, it's a bank run can happen at any time. like at any bank, because no bank is going to have a dollar to dollar, just the way like modern like fractional banking works. And that's a bit of generalization, but this is kind of just like no bank, because our banks always have like longer duration assets, so it's not going to have perfect one to one for every deposit. So the entire issue is basically that if the bank needs to convert some of its treasuries, get it to into something that's more liquid in order to meet potential redemptions in the form of customer liabilities being withdrawn, the deficit and loss, and then that loss affects your equity. And so all of a sudden you basically have like negative equity. Is the idea that where like some of those potential losses would wipe out equity. The equity is basically a buffer in the bank. Where like so pretty much like it's pretty much where it's like if liabilities has to get impaired, or if equity has to get impaired, equity is going to get impaired first. Because in order to protect the consumer deposits, your deposit at the bank, because that's systemically, or from a perspective, regulator probably more important than a shareholder. So the entire issue is basically that there's a mismatch between a bank's assets and its liabilities, where the assets are long duration, but a customer deposit is basically always short duration, that a customer can the next morning withdraw his money or withdraw the money that's above the 250 FDIC limit, right? So you have that issue. And so in the case of Silicon Valley Bank, and of course all these banks are different. Like Silicon Valley Bank is much more so a traditional bank run, whereas First Republic is more of a mismatch in the asset. First Republic, FRC, lots of mortgages. Rich people. There's been some fun stories like honestly, like if like the best investment from COVID isn't necessarily like any specific company per se, but more so instead of just locking in like the 2% 20-year mortgage or something like that. That was the real truth. Because basically, like the funny thing, right? This is a non sequitur, but this is a tangent. But like, if you have a mortgage at like 2% from COVID, and if your savings account is now paying 4.55%, like, of course, like like the nominal dollar of your principal on the mortgage is different from the nominal value or how much money you have in your savings account. But in a certain sense, like you have basically become the bank where your net interest margin, covers your mortgage. You have as a consumer, you have a positive net interest margin, which is a very funny concept to think about. So basically, that in like the 5 minutes it's been talking about that, like that really is like what is going on. I don't know what like online is talked about, but it basically is just asset to liability mismatch, mainly because of long duration assets. Maybe it's I guess a mortgage is a loan, but it's differentiate the two. So that's why we have these issues nowadays. So what's the First Republic Bank? Again, May 1st. So the issue of First Republic has been going on for a while. First Republic is really volatile, right? Depending on different events, like market sentiment over their situation of their prospects. So JPMorgan stepped in. Of course, JPMorgan being the largest U.S. bank certainly would provide stability. At the same time, JPMorgan being the largest bank, you want that bank to get even bigger, consolidate the space. I don't know. I'm not the biggest skeptic. Personally, I'm not the biggest skeptic of market consolidation because it certainly becomes like entertainment, like whether like media or gaming or sports betting, lots of areas. It seems like there is an efficient frontier of financial institutions. The U.S. has way more financial institutions than the rest of the world. The rest of the world has. If you go to different countries, there's way fewer banks. The U.S. is unique in having that many regional banks, having that many banks that spread out. So that's It's a more substantive policy question. But yeah, but at the end of the day, uh, I guess it's number 7, and as a JPMorgan shareholder, from back when they had some money laundering issue from September or October 2020. Can't complain too much, right? Ratios, capital ratios. It's kind of like your the idea of you have a capital, your equity is a buffer. It ties into that. Again, to the point you have your assets, right? Cash, marketable securities, and your loan book. So you have that. JP Morgan's operating model, shareholder value. Always got to be a fan of that. Good old shareholder value. Am I right? Business position, principal, yeah, nothing too much here. But again, to your point, right? JP Morgan, largest U.S. bank. Transaction over. Okay, and this is talking about the actual deal itself. This is how the balance sheet changes year to post-transaction after the transaction closes. Interesting things to note. JP Morgan is not assuming corporate debt or preferred stock. This kind of means that those guys are getting zeroed out. This is what I said earlier about First Republic's assets being much more so in treasuries. Let's say something about a bank where 173 billion of loans plus 30 securities and treasuries. That's a pretty big swing. FDIC payment is kind of like what JP Morgan is paying to acquire the bank. Of course, the FDIC is still going to take a loss, which the FDIC will make back in the quote unquote insurance premiums they charge to the banks. JP Morgan will repay itself because what happened a couple weeks ago was these are talking mid-size of the large banks beyond it, not just the big four, but also them depositing money to in First Republic. The issue is you deposit money, so you put in asset cash, but you also create the liability. So it's 1-to-1. It's not increasing the margin. An interesting thing, JP Morgan or the FRC didn't. I don't think they disclosed what rate that finance is at. You can't imagine it's too high a rate. Then it's is it above the market rate? Is it below the market rate? If they're not publicizing it, because makes you think that it's either under the market rate, or the FRC is giving JP Morgan a nice form of liquidity that they don't need per se. Or if it's above the market rate, then maybe JP Morgan doesn't want to say it because that's negatively affecting JPM. And of course, because the FRC was so involved, potential bank runs, and instability required decisive action. No regulatory shenanigans. Pro forma one-time gain. This is kind of why net income is a bit fungible. Because or I guess some types of maybe have adjusted net income that backs out one-time events. If you have one-time events like this, right, that might skew your net income a bit. Loan mark of 87%, which means that in this deal, JP Morgan has already written down the value of those loans by 13%. Maybe they should be written down more, but still, I think that JP Morgan has a book value it's comparable with, and your average risk weighting ties back into this figure for its assets, because not all assets are as risky as others in terms how much the dollar value can go down by versus others. So it backs out that way. And still maintain a good stock ratio as a systemically financially one bank. The nice thing, right? So the prior point of FRC, First Republic, having a lot of mortgages to rich people, presumably then a lot of rich people bank with you in order to get those low price mortgages. And so this goes JPMorgan. So and the client base. I personally am not a JPMorgan client or user. I don't have any interest in their savings account checking. Don't really think their investing platform is that interesting. So I can't really speak to that. I still like to speak to what the banking world of like high net worth clients of high net worth people is. But I mean, it's beneficial and presumably right. Richer people are probably more attractive or more revenue generative clients than a poor person. Although I guess that's not true, or at least it wasn't. Maybe with like overdraft fees, but I guess that's changed recently. That's the big thing. That's like the most businessy thing. The other thing is like, so JP Morgan does get some more assets, does get some more. Uh, I guess it's to be determined how much of a benefit those mortgages are going to be. JP Morgan, right? Single family, or just like traditional mortgage, basically. And CRB, commercial real estate, multifamily apartments, comprehensive due diligence, like the integration plan. Not sure how many like layoffs there'll be. Maybe not too much because I think JP Morgan is still like competing with like Morgan Stanley to build out its wealth management stuff. So maybe not too much of an impact. And then it is like a lot of buzzwords, TBH. But that's basically it. So if you learn anything today, so like there really is in terms of, like the first like 10 minutes is like the most helpful in just like really putting into context like why there's these issues around potential issues around banks and why like First Republic uh, and Silicon Valley have had the issues they've had. Where and the issue really is just that you have a mismatch between your assets and your liabilities, and that mismatch in the potential losses you have to take just wipes out your equity, which that means you're still digging back into your liabilities. That's what it is. Like basically, this formula does not balance. It's not balancing because interest rates have gone up, and so treasuries and other mortgages and other long duration assets have gone down. Banks have long duration assets. It's kind of like anything. It's kind of the business model. Secondly, sometimes management's pursuing maybe net income, marginally discern EPS, or whatever. And so that is that. So that's JPMorgan, First Republic. A lot of Warner Bros. With the writer strike, that's going on. Revenue numbers, deceleration in revenue, better cost management. Not sure what adjustments you're talking about. Let's see what adjustments, share-based comp, pyramid charges, one-time events, and that's I'm not sure how much solution Warner Bros. Is doing. Yeah, ad market's tough. Less ad spending, or at least that's like the general vibe. In the sense there's less ad spending. Cash flow, well, yeah, it's a bit fungible of a number. Hogwarts Legacy, Warner Bros. Games division, right? They also have like Multiverses, probably something that also interacted with. Yeah, the Olympics makes like year over year, it's probably the most common comparison because like your holiday season, like Q4, is going to operate differently from like your Q1. So it's not the most fair to do a quarter over quarter. That's how you should do year over year. Uh, yeah, I guess in the Olympics, there's like those big events makes a bit of an impact. I guess the same way maybe like Comcast or Viacom or Paramount kind of have like after this their Super Bowl year, some have to back it up. OpEx profitability in 2023, HBO Max. Oh, that's nice profitability. Yeah, because I think I was listening to the interview and he said that David Zaslav, Warner Bros. CEO, said that they got profitable under streaming. Uh, so I guess yeah, but it's supposed to a degree if there's any point of interest for the strike, maybe that is like Warner Bros. Is profitable on streaming. Because it seems that streaming is the big contentious issue. But then again, um, lots of moving parts, and uh, and we'll see how much of an impact or how long the strike goes on, and how much of an impact that has on like content pipelines and subscribers, debt. Variable versus fixed rate. Variable can change depending on what the market rate is. So probably your variable. And of course, like the double-edged sword. Uh, if interest rates go down, the variable helps you. If interest rates go up, the variable rate hurts you. In this case, nowadays interest rates going up, so you're probably getting hurt. But in this case, where most of the debt is fixed rate. So probably, I'm not sure what WBD's investment rating is or credit rating is, but I, I don't think it's. I don't think we have a fixed rate. I don't think it's less than JPMorgan's the fixed rate financing. It's probably more than whatever JPMorgan got. Debt maturities 20. So a quarter of the debt is going to be due in 3 years, almost half 10 years. So yeah, the cash flow. I mean, presumably, Warburg's probably can. Because EBITDA is 2.3 billion. I think some of that's actual cash. Uh, yeah, so presumably you think that Warburg's good service instead. So not too much of an issue. Okay, so Warner Bros. Isn't investment grade, so it's below like triple B, I think. EBITDA, so your growth, leverage, forex. Yeah, so one real big thing is I've read Warner Bros. Earnings stuff past couple of quarters. It does seem like like the pivot to Max. It's not like you think of like who has streaming properties and who like deserves to make it. Like Warner Bros. You think, yeah, probably do deserve to maybe more so than Paramount. Um, but of course, from the shareholder perspective, in terms of like your total shareholder return, your TSR, you're not going to be getting dividends anytime soon. Probably not getting too many buybacks anytime soon as well. Just because that is 46, yeah, 40, excuse me, 50 billion of debt for a 31 billion market cap company. So your enterprise value is 81, $82 billion enterprise value. So still a road ahead to delever this company. Of course, ideally, you think that at a certain point, certainly when like these 3-year debt maturities have come up, the road forward for streaming is a bit more clear. So that's that. So, anyways, it's good to be back streaming. It has been a while. So today, talking about minutes, basically the pretty high level overview as to what is going on with the banks, what is the bank crisis, and then thinking about Warner Bros. Discovery, which, while of course Warner Bros. Is different from say Netflix or Paramount or Comcast, it certainly does provide some context. Certainly has to the perspective of like the executives when it comes to this strike to some degree. So thank you for watching, and I think I'll definitely my upload schedule, the streaming schedule is going to be a bit more active moving forward into the summer. So thank you for watching, and continue to be safe.